So, let's talk about a company that seems to have it all. I mean, it's sitting right at the heart of India's manufacturing boom, it's growing at an insane pace, and its future, well, it looks incredibly bright. But all of that success comes with one very, very big question mark. $221 billion. Let that number sink in for a second. That is the projected size of India's electronics manufacturing market by the year 2040. This isn't just growth we're talking about. It's a massive tectonic shift in the global industrial landscape. And believe me, it is happening right now. And what we're really seeing here is nothing short of a modern-day gold rush. You've got this perfect storm of government policy, global trends, and just a huge surge in local demand. And it's all coming together to create a manufacturing explosion.
Yeah, this boom is definitely not happening by accident. It's being fueled by some really powerful tailwinds. You've got the Make in India policy, which is pushing hard to cut over $100 billion in imports. Then you have global companies actively looking to diversify away from China. And as if that's not enough, the government is throwing billions in incentives on top of it all. It is the perfect recipe for domestic manufacturers.
And smack dab in the middle of this perfect storm is a company called KAYNES Technology. They are, quite simply, perfectly positioned to ride this massive wave of industrial transformation.
So what's their secret sauce? What makes KAYNES so special? Well, it all comes down to their business model. See, they aren't just an assembly line. They are a design-led manufacturer. This means they're involved right from the very start, helping to actually design the products they build, especially smart devices that connect to the internet, the Internet of Things or IoT. This adds a ton of value and makes them a critical partner, not just another supplier.
And you might be asking, does this strategy actually work? Well, the numbers are just stunning. Between 2020 and 2024, KAYNES grew its revenue at a compound annual rate of nearly 38%. Just wrap your head around that, growing by almost 40% every single year for 4 years straight. That is absolutely explosive.
But hold on, it gets even better. Growing your revenue is one thing, but check out their profitability. Their net profit grew at a compound rate of almost 80%. This shows just incredible operational efficiency. It means they're not just getting bigger, they're getting smarter and more profitable with every single thing they sell.
And this train, it is not slowing down. This number, over 7,400 crore rupees, is their current order book. That's the total value of confirmed work they already have lined up. It's this massive pipeline that basically guarantees this high-speed growth is already locked in for the foreseeable future.
Okay, so how do they stack up against the competition? When you look at the projections, KAYNES isn't just in the race, they are lapping the field. Analysts are projecting them to grow at 46% annually, which just blows their major competitors out of the water. They are really in a league of their own.
So how do they protect a business this incredible? Well, they've built a seriously powerful competitive moat. It all starts with that design leadership and their unique expertise in IoT. But they've also diversified into these high-value, really hard-to-enter markets like aerospace and defense. And the real kicker? They're making a massive bet on the future, investing 61 billion rupees to build their own semiconductor facilities. That's a move that could completely transform their business all over again.
I mean, it's just a phenomenal story of growth, of strategy, and pure ambition. It sounds like the perfect company, right? Which leads us to the one obvious question. What's the catch? Because with a story this good, there's always a catch.
And the catch, my friends, is the price. The price you have to pay to own a tiny piece of this incredible story. The market sees this perfection, and it has priced it, well, perfectly.
This right here is the company's price-to-earnings or PE ratio. It's just a simple way to measure how expensive a stock is. And KAYNES says is nearly 135. Let me put that in simple terms. For every single rupee of profit the company actually makes, investors are willing to pay 135 rupees for a share of it. It's just a sky-high number that has enormous future expectations baked right in.
And that number looks even more extreme when you put it next to its peers. The median PE for similar companies is floating around 49. KNS is trading at more than double that, a massive, massive premium compared to its closest competitors.
So, what does this all mean? It means the market isn't just expecting growth, it's demanding absolute perfection. When you have a valuation that's 175% higher than your peers, there is zero room for error. No room for a delayed project, no room for a missed quarterly target. Nothing.
So you've got this incredible company on one side,
and this frankly terrifyingly high price on the other. How do the experts, the financial analysts on the street, even begin to make sense of this dilemma?
Well, one common way to value a company is to try and predict its future cash flows. And doing that lays out this high-stakes bet perfectly. In the bull case, if absolutely everything goes right, the analysis suggests a potential upside of maybe 13%. But in the bear case, if they stumble even a little bit, the potential downside is over 60%. The risk of losing money is just so much greater than the potential for gain from where we stand today.
And that imbalance of risk and reward, you can see it reflected right in the analyst community. They are completely divided. The most common recommendation isn't buy, it's a very cautious hold, with a pretty big chunk of them even suggesting to reduce your position.
This quote from the value picker investment community, it just sums the whole situation up perfectly. Right company, wrong price. Pretty much everyone agrees it's a fantastic business. The big worry is just that the stock price has gotten way ahead of itself.
And so, the deep dive analysis we've been walking through, it lands on the exact same conclusion. The final recommendation is hold. Look, while Kaynes is a phenomenal company, its current stock price simply offers a poor margin of safety for anyone looking to put new money to work.
So, after all that, what are the key things to take away from the story of Kaynes? First, and this is a big one, a great company does not always equal a great investment, at least not at any price. Second, you have to remember that a high valuation is just the price you are paying today for growth that's expected years from now. That means investing in Kaynes today is really a bet on flawless, perfect execution. And finally, it just goes to show why you always have to understand both the bull case and the bear case before you ever make a decision.
Which leaves us with one final fascinating question to ponder. When you find a company that is truly leading a revolution in a massive, growing market, is there a price that is simply too high to pay? Now that is the billion-dollar question you have to answer for yourself.